Introduction. Through the course of human civilization, the concept of money has evolved dramatically. From gold coins to bitcoins, we have certainly come a long way. No matter what money means to people, the one thing that has remained constant is the steady demand. The amount of money that you have has always been an indication of your status. Money has played a pivotal role in personal and societal economic growth. Our entire economy is measured in terms of money and how much of it is being ejected in and eroded out every day. We have reached a place where Bitcoin and other cryptocurrencies have significantly disrupted the financial sector. Cryptocurrencies are showing promise to become an alternative medium of exchange. However, their biggest drawback is that most people have no clue what they are and how they work. Blockchain is the technology behind cryptocurrencies, and it is quite complex. The general notion is that if you are not a techie, then you will never be able to understand anything remotely related to crypto. This is what makes people scared to approach it, and it remains to appear as a distant star to the average person. However, this mindset can quickly be altered, given how easy it has to become to know anything these days. There are a few questions a simple Google search cannot solve. But when it comes to cryptocurrencies, you might have to work a bit harder. There is so much information available on this topic that somebody who is approaching it for the first time might easily get overwhelmed. Do not panic, because that is where we come in. Through all of our years of experience in the cryptocurrency scene, we have gathered valuable information and insight about this topic, which we will convey to you through the course of this book. It will be simple and direct, and by the time you are done reading, you will have all the basic knowledge regarding everything related to cryptocurrencies. So sit tight and buckle up, because you are about to embark on this delightfully technical journey. Chapter 1. Definition and Evolution of Money. Money is the all-important asset that everyone is chasing. We need money in every part of our lives. No matter what the philosophers say, we need money to lead a happy and healthy life. There is no shame in accepting the importance and dominance of money. The faster you start understanding its value, the better you will be able to manage it. Today, we are convinced about its necessity, but can you imagine there was a time when there was no money in the world? From a world devoid of any currency to a world filled with digital tender and cryptocurrencies, how did this paradigm shift take place? To understand this journey, let us first look at the definition of money. Money is an economic unit that functions as a generally recognized medium of exchange for transactional purposes in an economy. Money exhibits the following features. Fungibility. This means that all units of money are relatively uniform quality and can be interchanged with each other. Durability. The physical character of money should be durable so that it retains its value for a considerable period in the future. Portability. It should be divisible into small quantities, which can be easily transported by its holder. Recognition. A unit of currency of a country should be recognized in any part of that country. The currency should also have a global recognition, even if it's not directly accepted. Stability. The value of money should be stable. If a good fluctuates in value very frequently, then it is unsuitable to be considered a currency. Money did not have all these features in the beginning. Over time, money has become more refined as people start to understand its value and found more uses for it. Apart from being a medium of exchange, money has the following functions. Unit of account. Money is used as a medium of exchange and to assign values to goods and services. Store of value. In our economy, money can be used as a form of storing current capital and maintaining future capital. This means that if you save money in your bank, it will hold value in the future. Standard of deferred payment. Money can be used to make payments that are due in the future. When you borrow money from a lender, the real value of goods and services that you can purchase with that money is transferred. When the time comes for repayment, you can pay them back an agreed sum of money. Money makes this system of deferred payment much simpler. History of money. Every form of money becomes valuable when we decide to attach certain values to it. If the Federal Reserve did not consider dollar notes as an acceptable mode of currency, they would not have been anything more than mere pieces of paper. You know that when you go to your nearby store, you can exchange $20 for certain goods of your choice. That is what makes money valuable. Although the two terms are used interchangeably, many economists argue that money and currency are two separate things. Money is an intangible concept, whereas currency is its physical manifestation. No matter which word you use, money and currency has evolved a lot in the last hundreds of years. The barter system. Historians agree that the earliest medium of exchange was in the form of a barter system. Barter is a direct exchange of goods and services. For example, a farmer may exchange a bushel of wheat for a pair of hammers from a blacksmith. A barter system works when two parties agree to fix a relative value to the goods and services they are offering. However, the barter system faced some significant difficulties. First, there must be a coincidence of wants for the two concerned parties. For example, the blacksmith might want wheat, but the farmer might not require hammers or anything else that the blacksmith is offering. Moreover, the value of goods also might be perceived differently by different people. The blacksmith might feel that 2 hammers are a good price to pay for a bushel of wheat. The farmer, on the other hand, might consider a bushel of wheat much more valuable than 2 hammers. The barter system might have worked initially, but as the economy began to grow more complex, people started encountering problems with it. Gradually, over many centuries, a medium of exchange started developing in the form of salt, animal skins, or other easily traded items. Introduction of coins. When people began to realize that business was about to get bigger, they started migrating to a more common form of currency. Around 770 BCE, it was the Chinese who first came up with the concept of something resembling modern-day coins. Weapons were already being used as a common medium of exchange, and they started making miniature replicas of these weapons for convenience. However, reaching into your pockets and taking out a mini dagger was not the most desirable situation, and that was why these objects were made circular. These objects were some of the first coins. The Chinese might have made the first coins, but the first currency was minted in a European region called Lydia, which is now part of Western Turkey. In around 600 BCE, King Alyattes of Lydia created the first currency, which was made from electrum. Electrum is a naturally occurring substance that is a combination of gold and silver. These coins had pictures stamped in them, which acted as denominations. The currency system in Lydia helped strengthen its internal and external trade, and soon it became one of the richest empires in Asia Minor. There is still a saying, as rich as Croesus, which refers to the last Lydian king, who was the first to mint a gold coin. Paper currency. Again, the Chinese were the first to move paper currency in 700 BCE. When Marco Polo reached China between 1271 and 1295, the Chinese emperor was already on the money supply and different denominations. In fact, in the place where modern American bills say, "In God we trust," the Chinese inscription at that time warned, "Those who are counterfeiting will be decapitated." Many parts of Europe still used coins until the 16th century. This was possible because of their colonial efforts, which kept on providing a steady supply of precious metals. However, these coins were soon replaced by paper currency when banks started issuing notes to depositors and borrowers. Paper currency was easier to carry around and facilitated trade. People could exchange paper notes for their equivalent face value in gold or silver coins. Paper money could also be used to buy goods or services. The major difference between the currency in those days and that of today was that they were issued by banks or private institutions instead of the government. The first paper currencies in Europe were issued by the North American colonial governments. Trade between Europe and North American colonies took very long, and often the traders would run out of cash. To solve this problem, the first paper currency was issued in Canada, which was then a French colony. Evolution of money. As time has passed, money has seen massive evolution. Initially, we saw the existence of commodity money, where a commonly accepted commodity was denoted as a medium of exchange. This paved the way for metallic money in the form of coins, which was in turn replaced by paper currency. Along with paper currency, we also saw the emergence of credit money. Banks played an important role in popularizing credit money by providing depositors with the facility to draw money through checks. Now, we have reached an era of plastic money and digital currency that is revolutionizing all our concepts regarding the financial system. Let us understand the roles played by credit money and plastic money in the evolutionary journey of the financial system. Credit money. Credit money can be defined as monetary value created as the result of some future obligation or claim. Credit money is considered when debts are issued or credit is extended. When commercial banks issue loans that are greater than the reserves held by them, credit money comes into existence. Credit money can assume numerous forms, including IOUs, bonds, and money markets. In simple words, any form of financial instrument that is not meant to be repaid immediately can be regarded as credit money. Plastic money. In 1988, the Reserve Bank of Australia came up with the first polymer banknote, which can be regarded as the earliest plastic money. When we say plastic money, we usually mean debit and credit cards. It might have been met with apprehensions initially, but today, plastic money has replaced physical cash in numerous areas. In fact, after the outbreak of the COVID-19 pandemic, many stores across the world made it mandatory for customers to use only plastic money or contactless payments as a precautionary measure. Plastic money was widely used by executives whose jobs demanded frequent traveling. Carrying high amounts of cash was not feasible, and plastic money provided an easy and safe alternative. Cash has a high chance of being stolen, whereas debit and credit cards are protected by secure PINs, which are not very easy to hack. Moreover, even if your cards are stolen, you can easily make a call to your bank and instruct them to block your card until further notice. Credit cards have given easy access to instant credit to their holders, which means you don't have to ask anyone for money in case of an emergency. Most debit and credit cards are accepted internationally, which removes the hassle of currency exchange. Plastic money can be regarded as the bridge between traditional currency and other modern and digital forms of money. The future of money and the digital revolution. A few centuries ago, safekeeping of your treasure referred to storage in underground troves or other similar secret arrangements. Back then, savings consisted of a box of gold coins and some other precious stones. Today, your investment portfolio or treasure looks completely different. You don't need to dig a hole in the ground to find a secret spot and keep your money safe. There are banks, vaults, and other security measures that you can adopt. The use of money might be universal, but the way we are using it is changing rapidly. When you open your wallet, the dollar notes and the coins that you see are physical forms of money. However, as the digital revolution is taking over the world, physical currency is being replaced by digital payment. Now, most millennials don't prefer carrying cash because they can make contactless payments via plastic money or digital wallets. In the last 30 years, more than 600 currencies have vanished from the world. This is a clear indication that the way we perceive money is changing rapidly, and that is why we must be equipped to take on this shift. Let us look at the major elements that are making this change possible. Mobile and contactless payments. The COVID-19 pandemic has drastically changed the way we make payments. Contactless payments are now the most popular mode of payment across the world because they reduce the contact associated with physically paying and receiving cash. Contactless payments can take place in two ways. Mobile wallet or app payments. In this case, you have to open a certain payment app or digital wallet on your phone and use the camera to scan the QR code displayed at the checkout counter of the store. When you scan the code, a page opens up on your app or wallet where you can enter the amount to be paid, followed by your PIN to complete the transaction. Contactless technology embedded directly into the card. Your credit card might have a chip embedded in it that enables easy and contactless payments. The payment terminal must have a near-field communication technology so that it can read the card when the card is brought near the device. Contactless payment options are also available in wearable devices, like smartwatches and fitness trackers. So people who don't like to carry their wallets around everywhere can simply use a wearable device to make a payment. Apple Watches and Android smartwatches, like Fitbit, have gained huge popularity because they are safe, and there is no danger of your data being hacked while you scan the code. Trends around the world. When money first came into existence, the world population was somewhere around 2 million. Now, with the population reaching over 7.5 billion, the world is seeing an increased demand for money. Economists have realized that the current monetary system might soon be a hindrance to financial growth in the world. People are trying to develop their currency, or, at least, build a world where currencies are independent of the various socio-economic or political factors. We are moving to a situation where money will be managed by communities and lending platforms, giving higher transparency and autonomy to the average person. Israel is a country famous for its innovation in the information technology sector. The country's economic climate makes it a suitable place to test initiatives regarding developing a futuristic currency system. The American company RoboCoin is setting up Bitcoin ATMs all over the world, which allow people to exchange their cryptocurrencies for cash. Israel has an active cryptocurrency market and is slowly becoming the hub for new startups that want to experience with virtual money. El Salvador accepted Bitcoin as legal tender in their country. In January 2022, New York City Mayor Eric Adams was among the first public figures who accepted their paycheck in Bitcoin and Ethereum. Right now, money is being handled by the central banks of most countries. They are a single authority who is responsible for issuing and distributing currency. This has remained the system for many years now, but there is a lack of transparency in this system. The central authorities decide who is eligible to borrow money and the interest rates applicable for every borrowing and lending transaction. Certain financial instruments are used to regulate the money supply and interest rates. This might bring about the economic upturns and downturns. This system certainly has its benefits because it's been around for a long time. Most cryptocurrencies today are not directly controlled by any central authority. which gives them a degree of autonomy compared to other currencies. Cryptocurrencies have, undoubtedly, created a huge disruption in the global financial markets. No matter what the traditionalists say, crypto is here to stay, and it will become a bigger part of our daily lives. However, most people still have no clue about what cryptocurrencies are or how they work, which is what makes them so inaccessible. To understand crypto, you must understand the technology behind them. Chapter 2: Blockchain, the technology behind cryptocurrencies. There are a myriad of terms and technology behind cryptocurrencies that we do not understand. You can dig up thousands of pages worth of literature, but it would still seem complex if you do not understand the basics. The first step to understanding cryptocurrencies is to have an idea about how it works. To do that, you need to know everything about the underlying blockchain technology. Breaking down blockchain. Blockchain is often regarded as one of the biggest inventions of the 21st century because of its rippling effects in various sectors of the economy. While people started talking about it after Bitcoin came into the picture, the origins of blockchain date back to the 1990s. Stuart Haber and W. Scott Stornetta were the creators of a technology resembling blockchain in 1991. They created a technology out of cryptographically secured chain of blocks so that nobody could tamper with the timestamp of documents. In 2008, it was Satoshi Nakamoto who published a paper on modern-day blockchain technology as the foundation of Bitcoins. Satoshi Nakamoto is an anonymous person or a group of people who created the white paper for Bitcoin titled Bitcoin, a peer-to-peer electronic cash system. The persona of Satoshi Nakamoto was integrally involved with Bitcoin in its early days. All inward and outward communications between Satoshi Nakamoto and the rest of the world were done digitally, which made it even more difficult for people to track their identity. After 2010, Nakamoto was no longer actively involved with Bitcoin and told another developer via an email that they had moved on to other things. It is thought that Nakamoto owns around 1 million Bitcoins, which means they are a billionaire. The first blockchain was conceptualized by Nakamoto when Bitcoin was formed, and, eventually, it has evolved and found its way into multiple other applications. For the longest time, blockchain was used synonymously with Bitcoin because the two concepts came into public notice together. Before we delve deeper into the concept of blockchain, it is important to know that Bitcoin and blockchain are not the same things. Blockchain is the technology based on which cryptocurrencies work, and Bitcoin is a form of cryptocurrency. What is blockchain? Try to imagine a ledger where accounting transactions are recorded. Even if you are not from an accounting background, you must have a rough idea about those. Most companies now maintain their records digitally. Whenever a transaction takes place, the accounting department records it in the system by creating journal entries or something similar. After a certain period, say a quarter, all these transactions are finalized, and a quarterly financial statement is prepared. However, the biggest drawback of this system is that any concerned person can easily commit fraud by changing these figures. Blockchain is very similar to this digital ledger where you can enter transactions. But every transaction goes through a strict verification scan before being entered into the system. Moreover, if anyone wants to make a change, the majority of the systems in the blockchain need to agree. Think of it as a party with limited access. Attendees need to mention their unique password before entering, and if anyone wants to make a change in the guest list, they need permission from the majority to make this happen. The working of a blockchain is similar to this system. Now comes the technical part. Blockchain is a database that is distributed and shared among the nodes of a computer network. It is similar to a database that stores information in digital format electronically. Blockchain uses peer-to-peer technology in its distributed ledger to securely store and record transactions across multiple computers. The contents of the ledger are updated once more blocks are added to the original network, forming a chain of blocks. The participants of a blockchain network can carry on transactions without any central arbitrator, like a bank or any government. Moreover, blockchain ensures the security and fidelity of a record or data, thereby generating trust even without a trusted third party. How does blockchain differ from a traditional database? As we have already established, blockchain is essentially a database. Let us see what makes it different from a traditional database. The basic difference lies in the data structure. In a blockchain, information is collected in groups or sets, also known as blocks. These blocks have limited storage capacity, and once a block is filled, it is closed and joined to the previously filled block. These filled blocks create a chain known as the blockchain. On the other hand, the data structure of a traditional database is in the form of tables instead of blocks. Traditional databases use a client-server network architecture. The data is usually stored in a centralized server, which can be modified by a user or a client. The database is controlled by a designated authority, who authenticates the credentials of every client before allowing them access to the database. Since there is a centralized authority controlling the whole database, the entire database can face a security threat if the central point is compromised. Blockchain consists of several decentralized nodes, where each node has a copy of the entire database. Every node verifies the addition of a new block to the blockchain and can enter new data into the database. An addition can only take place when the majority of the nodes reach a consensus. The mechanism ensures security and transparency within the blockchain database. How does blockchain work? The working of a blockchain is pretty simple if you break the steps down into pieces. Step 1. A transaction or record is entered into the blockchain database. Step 2. The transaction is then transmitted across multiple peer-to-peer nodes, which are usually scattered all over the world. Step 3. The nodes in the blockchain network solve various equations and confirm the validity of the transaction entered into the system. This is the point where the consensus mechanism comes into play. We will talk more about it in the next chapter. Step 4. Once the legitimacy of the transaction is verified by the majority of the nodes, the records are clustered into blocks. Each block has a specific storage capacity, and once it is filled, it is closed. Step 5. All the filled blocks are chained together, where you can find records of every transaction that has ever been recorded into the blockchain. The transaction history becomes permanent. Step 6. The transaction is complete, and the blockchain is ready for the next one. These steps demonstrate how a transaction is entered into a blockchain and how the process works. Blockchain ensures transparency within a database, which is why it is rapidly gaining popularity in many fields of the economy. Important terms related to blockchain. This technology is a bit complex, especially for people from a non-technical background. However, once we simplify the basic terms, it will become much easier to comprehend. Symmetric and asymmetric cryptography. The whole concept of cryptocurrency has its origin in cryptography. In this context, cryptography can be regarded as a technique that uses high-level mathematical principles for storing and managing data. The data is transmitted in such a way that only its intended reader can understand or process it. The creator encrypts the data so that no outsider can eavesdrop or tamper with it. The data can only be decrypted by the authorized user. Symmetric cryptography is a relatively simple kind of cryptography where only a single key is used to encrypt and decrypt the data. The key can be anything, ranging from numbers to a random sequence of characters. The receiver needs to have the same key as the sender to decrypt and decode the message. A big problem of symmetric cryptography is that the key needs to be shared with everyone who has access to the data, which can compromise the security of the system. On the other hand, asymmetric cryptography uses two different keys for encrypting and decrypting the data. This removes the main problem of symmetric cryptography because instead of a single key, the system works with shared keys in pairs. Public key and private key. Blockchain technology uses asymmetric cryptography. It uses two pairs of keys, known as the public key and a private key, for encryption and decryption of data. A public key is publicly shared with everyone, and anyone who has access to it can view the transaction history within that account. The public key is connected to a password, which is also called the private key. Despite their connection, there is no way anyone can derive the private key from the public key. A public key contains information related to cryptocurrency addresses, while a private key provides access to the transactions within these addresses. The access is allowed only to specific people. The use of asymmetric cryptography ensures that sensitive information is not passed on to unauthorized people. For example, if you want to send crypto to your friend, you will ask for their public key. Once the crypto has been transferred, your friend will need to produce their private key to prove that they are the owner of the crypto that has been sent. Digital signatures. Digital signatures use asymmetric cryptography to provide integrity to various protocols. Because of their incorruptible nature, they are widely used for authentication purposes and have proven to be very secure. Digital signatures are non-repudiable, which means they are legally binding as physical signatures. In cryptocurrencies, digital signatures are used to sign online transactions more safely. Multi-signature contracts are designed in such a way that they need digital signatures from multiple private keys before the execution of any action. For example, the Bitcoin network uses the elliptic curve digital signature algorithm as its digital signature scheme. The digital signature ensures that the sender of a transaction holds the private key belonging to a corresponding BTC address. Hash. Every transaction entered into the blockchain needs to be validated by the entire system. Blockchain miners work with supercomputers to make sure that the transactions are made and recorded properly. Blocks in a blockchain are created only when the transactions are duly validated, and that is how the chain is formed. To execute this task seamlessly, the miners need to find an identifying password or digital fingerprint. A cryptographic hash function takes an input of variable length to produce outputs of a fixed length. This output is known as a hash, which is unique, unrepeatable, and cannot be modified. Whenever miners discover a new hash, it is distributed across the system of nodes in the network to ensure continuous synchronization. Hash functions are used widely in cryptocurrencies so that transaction information cannot be exchanged anonymously. Hash functions can also be used in signature verification, password verification, and verification of file and message integrity. Hash is regarded as the backbone of a blockchain network since it links individual blocks of transaction data. For example, Bitcoin uses the SHA-256 cryptographic hash function in its algorithm. To summarize and simplify, one of the main purposes of a hash is to create a link between blocks in a blockchain. Fork. Blockchains have a unique democratic environment where everything is decentralized and all the parties process every relevant piece of information. This creates a sense of equality within the system. However, this apparent strength also poses a major threat. If everyone has to agree with the changes, then making a change within the system becomes increasingly difficult. To facilitate the process of making changes, one has to adopt a certain degree of centralization, and that would defeat the whole purpose of a blockchain. This paradox gives rise to forks within a blockchain network. Inside a blockchain, a group of users might face opposition from another group while incorporating changes in the network. This may result in a fork. In this context, it is important to understand the concepts and differences between a hard fork and a soft fork. A hard fork is a situation when the nodes of the latest version of a blockchain refuse to agree with the previous versions, and as a result, there is a permanent divergence from the previous version. Whenever a new rule is added to the blockchain, a fork is created, and the entire blockchain needs to upgrade to the latest version. Forks can also be created when developers of the existing blockchain grow dissatisfied with the current version and want to bring changes. A hard fork was experienced in the Bitcoin network when there was an argument over the size of blocks in the Bitcoin blockchain, and it gave rise to Bitcoin Cash. In 2016, Ethereum experienced a fork when a hacker attack exploited a vulnerability in the source code. This fork caused the split between Ethereum and Ethereum Classic. In the case of a soft fork, only the new version can exist once the existing blockchain has been updated. Unlike a hard fork where both the old and new versions can coexist. The previously valid transactions are made invalid as the system upgrades to a newer version. In times of a temporary divergence in the blockchain, a soft fork might emerge when miners using non-updated nodes violate a new consensus. Soft forks have been used in Bitcoin and Ethereum networks to implement new functionalities. Token. Traditionally, the word token was used to mean chips acquired for money at a casino that could be used for gambling, or for playing games in a video game arcade. In a blockchain, the meaning remains the same but has become virtual, and each blockchain has its own tokenomics. Tokenomics refers to the demand and supply mechanism and characteristics of a certain cryptocurrency. It includes everything related to the workings of a crypto asset and the behavioral forces that could affect its value long term. Projects that have well-designed tokenomics are more likely to succeed in the long run because they efficiently incentivize buyers to buy and hold the token. Seed phrase. The cryptocurrency and blockchain world takes pride in its self-sovereignty. This has the following implications. Anyone should be able to trade on this platform without revealing their identity. Nobody should have to depend on a third party for conducting their transactions and storing cryptocurrencies safely. Both of the above conditions are fulfilled by blockchain. Blockchain uses algorithmically generated password-like codes, which will be accessible only to the specified holders. When you set up your crypto wallet to conduct cryptocurrency transactions, the wallet generates a string of simple words known as the seed phrase. This seed phrase gives you access to the crypto associated with that wallet and is used for the creation of private keys. The seed phrase is a series of 12 to 24 words. It can be words like army, energy, fabric, opera, or anything that fits the criteria. Since people find it difficult to remember long strings of numbers, numerical values are not assigned to seed phrases. You must remember and keep track of your seed phrase, since it unlocks your wallet and the private keys associated with the crypto in that wallet. If you lose it, you will never be able to recover it, and you will subsequently lose access to all the cryptocurrency that you are holding in that wallet. Each seed phrase is selected out of a list of 2,048 common words. In 2013, the Bitcoin Improvement Proposal 39 first came up with the idea of having one seed phrase that would control all the private keys in your wallet. Merkle trees. Merkle trees, or hash trees, are a fundamental part of a blockchain network. A Merkle tree is composed of hashes of different blocks of data, forming a mathematical data structure. This structure represents a summary of all the transactions within a block and allows secure verification of the content and consistency of data. Merkle trees can be found in both the Bitcoin and Ethereum networks. Blockchain address. A blockchain address can be considered as something similar to your email address. It is a unique sequence of numbers and letters and refers to a specific destination where you can send the cryptocurrency. This can often be a simple process like scanning a QR code. To send cryptocurrency, you need to provide the public blockchain address of the receiver. Bitcoin addresses start with either a 1 or a 3 or a BC1 and are 26 to 35 alphanumeric characters in length. Uses of blockchain in various sectors. The unique decentralized nature of blockchain has made it popular in the global economy. Slowly, blockchain is making its entry into various sectors, and companies like Walmart, Pfizer, AIG, Siemens, Unilever, and many others have already implemented it as part of their business process. For example, IBM has created its Food Trust blockchain to trace the journey that food products take to get to their locations. The financial sector has been heavily influenced by blockchain disrupting banking and payment services. Let us delve deeper and see how blockchain is being applied in various fields of the economy. Financial sector. Eventually, finance may be revolutionized with the help of blockchain. If you deposit a check into your account on Friday at 6 p.m., the money will not be credited to your account until Monday. Even if you deposit a check on a weekday during normal business hours, it can still take 1 to 3 business days to get your money credited, because the banking network has a huge volume of transactions to verify. When a blockchain is integrated into this system, the overall efficiency of banking transactions improves. A blockchain never stops working, and a transaction can be processed very quickly. International transactions can also take place very quickly when a blockchain is used. If you are still skeptical about these applications, let us quickly review how blockchain is different from traditional brick-and-mortar banks. Traditional banks are only open on weekdays from 9 a.m. to 5 p.m., while blockchain is active 24/7 throughout the year. Whenever you are conducting any bank transaction, you have to incur certain transaction fees. For example, while making card payments, the fees depend on the card and are usually not incurred by the user directly. It has to be paid by the stores to the payment processors, which increases the final price of goods or services so that the burden could be shifted to the end user. You also have to pay charges on checks depending on the amount. When you are making a transaction on a blockchain, miners and users fix a certain fee. However, you have the option of determining how much you want to pay in fees, which creates an open market for doing business. If a user sets a very low fee, the transaction might not get processed. The magnitude of the fee structure depends on network activity and the market forces. High fees can often hinder the operations of the blockchain, while low fees can lead to a security concern. This makes the fee structure simple and transparent. The fees reduce spam attacks on the network because large-scale spamming becomes costly. Moreover, the fees also act as incentives to the users for verifying transactions. To make a transfer through a traditional bank, you need a government-issued ID, a bank account, and a mobile phone. However, transactions on the blockchain can be conducted by anyone with an internet connection. This may eventually change, though. Currency. Blockchain is the fundamental technology that hosts all the cryptocurrencies in its network. Since blockchain spreads its network across multiple nodes located throughout the world, it removes the need for a central authority to control the transactions. Healthcare. Blockchain can become a significant part of the healthcare industry by securely storing medical records. When a signed medical record is written into the blockchain, the patient can be confident that the record will remain unalterable. Personal health records are encoded on a blockchain with a private key, which will be accessible only by authorized people. Property records. If you take a trip to the recorder's office, you will see the burden and inefficiency of the process of recording property rights. A physical deed needs to be submitted to the concerned government officials at the local recording office. The official will then manually enter the property details into the county's central database and public index. If there is a dispute, one has to reconcile the claims with the public records. This is a tiresome and primitive process that takes time and money. Moreover, so much manual work is highly prone to error. When property records are maintained on the blockchain, there is no need for physical scanning. The records are safe and cannot be altered. Pros and cons of blockchain. Blockchain exhibits enormous potential in safe record keeping, along with reduced transaction costs, depending on the type of transaction. Let us look at some of the advantages of blockchain. The transactions on a blockchain network are approved through a consensus mechanism involving thousands of computers. Even if one node makes a mistake, that mistake has to be replicated by 51% of the other nodes for that mistake to affect the entire network. This improves the overall accuracy of the chain and the underlying transactions. Since blockchain networks are active every hour of the day, they improve efficiency and reduce related transaction costs. Cross-border transactions, or ones with high value, can easily be processed at a lesser time. Transactions on a blockchain network are public and can be viewed by anyone with an internet connection. However, nobody can access information about the people conducting those transactions, making the networks confidential and secure. This level of confidentiality may change over time. Blockchain is not devoid of any disadvantages. Here is a list of limitations that you can face in every blockchain network. Blockchain might save you some dollars in transaction fees, but maintaining a blockchain network requires high-tech computers and an entire sophisticated technological setup, which costs a lot more than your regular database. These computer systems also consume a tremendous amount of power. There are a few cases where you can save money on transaction fees, since it all depends on the complexity of the smart contract. Confidentiality and anonymity on the blockchain network open doors to many illegal activities. Multiple illicit transactions take place on the dark web through cryptocurrencies on the blockchain network. Moreover, the concept of decentralization is not always achieved. Since Bitcoin mining is so lucrative, a few large corporations control a major part of it. Blockchain boasts of being an independent and self-sovereign network, which means no fixed rules and regulations are governing the transactions. This results in a lack of control and makes the future of blockchains uncertain. Despite the cons, the importance and rising popularity of blockchain technology cannot be denied. The focal point of the benefits posed by blockchain lies in decentralization, which may change our business processes forever. Chapter 3: Blockchain Decentralization. Blockchain is a decentralized system, which is why it has piqued the interests of people all over the world. In this chapter, we will talk in detail about what decentralization entails and how that is useful to the integrity of the system. Understanding decentralization. Suppose a company owns 1,000 computers that store data relating to all its transactions. All these computers are stored in a warehouse under the same roof. The owners have access and authority to alter the data. The system works perfectly until, one day, there is a major power outage at the warehouse. The computers lose their data and no new transactions can be entered because the internet connection has gone down. Or a dishonest employee who has access to the systems decides to commit fraud. Currently, these threats are mitigated with the use of security measures and data center redundancy, but this is a major threat to centralized systems. Blockchain removes these hindrances by storing all the data across multiple nodes, which are located in different places. It removes the control and decision-making from a centralized authority to a distributed network of interconnected nodes. This helps in deterring an individual node's ability to exert authority and retains the functionality of the network. Since the data is stored in every node, it creates redundancy and maintains the fidelity of the data. A bad actor will never be able to alter the entire database since they will not have access to do so. What are the benefits of decentralization? Here are a few advantages of decentralized blockchain environment. In a decentralized blockchain network, nobody has to know or trust each other, which creates a neutral environment. If any participant tries to corrupt the data in any way, it will be rejected by the majority of the nodes. Most companies are involved in a complex process of data sharing and transfers. This data is usually stored and transformed in each node and resurfaces when it is needed. Whenever the data is transformed, there is a chance of data loss and a loss of data integrity. A decentralized database removes these hindrances by offering real-time access and a shared view of data. Most centralized systems put too much importance on specific actors. In most cases, these actors become the points of weakness within the system. Decentralization does not rely on a single node. It removes inefficiency by addressing exhaustion of resources, periodic outages, and other similar bottlenecks. A decentralized blockchain system ensures the proper utilization of database resources. This increases the quality of promised services and provides consistency to the system. Can decentralization in a blockchain prevent DDoS attacks? Blockchain enthusiasts have argued that transactions on this network are completely safe. While we evaluate the benefits of blockchain, let us verify the validity of these claims when it comes to distributed denial of service, DDoS attacks. DDoS exploits the weak links in any system. Suppose a network card inside a system gets overloaded with network traffic. This happens when the application, which is running on the network, is receiving more requests than it can handle. Usually, a traditional DDoS attack targets a single weak link of the entire system. When that link is attacked, the entire system goes down. There is more of a concern in the case of centralized networks, where a single fault can cause the entire system to shut down. Since a blockchain does not have a single point of failure, it is relatively safe from DDoS attacks. However, that does not mean the network is impenetrable. Since a blockchain network has multiple nodes, it makes the network vulnerable, leading to an overutilization of processing power within a server. An attacker can send multiple spam transactions to a blockchain, which fills up the blocks, leaving the legitimate transactions waiting. The blockchain is not being fully functional if the legitimate transactions are not being added to the blocks and not entering the ledgers. This type of attack is known as transaction flooding. Although the crash of an entire blockchain network is unlikely, DDoS attacks and transaction flooding can still cause the following problems. Software crash. The blockchain operates as software in each participating node. This software is entrusted with sending, receiving, processing, and storing transactions, and has built-in limits for the number of transactions it can store, or memory allocations. Whenever there is a transaction flooding, this software will malfunction and exhibit issues. Network congestion. Blockchains operate on a peer-to-peer network, which means every node sends a copy of the data they receive to its neighboring nodes. Every node receives many copies of a single transaction, and a transaction flooding attack can amplify this scenario and take up a lot of bandwidth. Bloated ledger. Transactions on a blockchain ledger cannot be removed once they have been recorded. A transaction flooding attack can cause a ledger to be permanently filled with spam transactions. Consensus mechanism. The consensus mechanism is the focal point of decentralization in a blockchain network. It is a fault-tolerant mechanism used in blockchains to achieve agreement of the majority of the nodes, or consensus, on a single data value or a single state of the network. Suppose, in your state, the database regarding the number of people holding valid driving licenses is maintained by a centralized government authority. Only that centralized authority can add, update, or modify the records of that database. Blockchains, as we all know, work as a decentralized and self-regulating system where nodes are scattered globally without the presence of a single central authority. The blockchain network receives hundreds of thousands of contributions every moment from across the world, and these contributions need to be authenticated and verified. This creates a dynamic environment within the network, which is why these ledgers need an efficient, functional, and real-time system to verify the genuineness of the transactions. The system has to be secure and be able to make all the participants agree on a consensus regarding the authenticity of a transaction and the status of a ledger. A consensus mechanism is a set of rules which decides whether the transactions entered into a blockchain are legitimate. Theoretically, you might argue that a hacker can take advantage of the consensus mechanism by controlling 51% of nodes or tokens. But it is not feasible in practice. The various types of mechanisms prevent such exploitation from happening. Types of consensus mechanisms. Blockchain has a variety of applications, and each type requires a different outcome. This is why it is important to have a variety of consensus mechanisms. Proof of work and proof of stake are two of the most popular consensus mechanisms used. Proof of work. This consensus algorithm is preferred by the more prominent cryptocurrency networks. The process is executed by miners who solve complex mathematical problems to produce a new block. Whoever solves the problem fastest gets to create a link between their block and the block that went before. This act of solving the problem is regarded as the work in proof of work. The participating node needs to prove that the work done by them gives the right to add new blocks to the blockchain. If anyone wants to defraud the network, they would have to control 51% of the network's computing power, which is not feasible and very expensive. Some examples of proof-of-work blockchains are Bitcoin and Dogecoin. Proof of stake. This is a low-cost and low-energy consuming alternative to proof of work. A validator is chosen at random who has to stake cryptocurrency they own belonging to that network. The more tokens they stake, the better are their chances of getting selected. If they try to defraud the network, they can lose the tokens that they have staked. Some examples of proof-of-stake blockchains are Cardano, Avalanche, and Solana. Proof of capacity. In this mechanism, complex problems are solved and stored in hard drives. Once a storage device is filled with these solutions, it can be utilized to create blocks. A node can successfully create blocks if it can solve the problems fast enough. A higher storage capacity improves a node's chance of creating blocks. Proof of elapsed time. This is a random and fair process where the producer of a new block is determined based on the time a user has spent waiting. A random wait time is allotted to each user, and the one whose wait time finishes first gets to create a block. Proof of identity. In this mechanism, the private key of a user is compared with an authorized entity. When a user's private key is attached to a specific transaction, the proof of identity mechanism provides a piece of the cryptographic evidence for the same, and an identified user can create and present a new block to the blockchain network. This mechanism ensures the authenticity and integrity of the data that is being created. Proof of authority. This is a modified version of the proof-of-stake mechanism where the verified identities of the validator are at stake. The correspondence between a validator's identity and official documentation is used to verify their identity, and they stake their reputation on the network. Only a small number of validators are allowed on the network who can eventually create new blocks. Proof of activity. This mechanism is a combination of proof of work and proof of stake. Miners try to solve problems to claim their rewards. The blocks created through this mechanism contain a header address that randomly chooses validators for signing a block. The validators with the highest stake have greater chances of being selected to sign, and this signed block becomes a part of the network. Delegated proof of stake. This can be considered as an evolved version of the proof of stake mechanism where users of the network are allowed to vote and elect delegates who will validate the next block. These delegates are also called witnesses or block producers. The users can vote on delegates by staking their tokens into a staking pool, which would then be linked to a particular delegate. There is no need to physically transfer the tokens to another wallet. A staking service provider can be used to stake the tokens. The delegates receive their transaction fees from the validated block. The users who have pooled their tokens into the successful delegate's block also receive a share of those rewards. The higher your stakes, the greater your share of rewards. Byzantine fault tolerance. In a blockchain environment, participants often interact with each other in an uncontrolled and open system due to the decentralized nature of the network. The actions of the nodes may vary based on their interests and can be malicious. A Byzantine fault-tolerant mechanism ensures smooth operation of the system, even if the nodes are malicious or failing. Comparison between blockchain and distributed ledger. In this section, we will talk about what a distributed ledger is and its similarities and differences with blockchain. What is a distributed ledger? A distributed ledger is a shared database that exists across several locations and multiple computer systems. Like a blockchain, it eliminates the need for a centralized authority for verifying, processing, authenticating, and validating transactions. Records can only be stored in a distributed ledger when the majority of the nodes agree to add them. How is it different from blockchain? When we look at the definitions, blockchain and distributed ledger seem to be the same thing. In essence, every blockchain is a form of a distributed ledger. We already learned in the previous chapter that in a blockchain, the data is arranged in a sequence of blocks, whereas a distributed ledger does not require such a structure. Decentralization is common to both blockchain and distributed ledgers, but the latter does not have a data structure, and the data is merely spread across multiple nodes, locations, and participants. Distributed ledgers do not require proof-of-work consensus, and, theoretically, they are easier to scale. The data sequence on a distributed ledger does not need to be specific like that on a blockchain. Moreover, nobody owns the data in a blockchain, and every participant has the same copy of the database. But, in a distributed ledger, responsibility is typically shared among network providers, solution providers, and customers. On the surface, distributed ledgers and blockchains have multiple similarities. But it is important to remember that blockchain is only a subset of distributed ledger technology. All blockchains are distributed ledgers, but not all distributed ledgers are blockchains. Blockchain is a more specialized segment of distributed ledger that is more suitable for cryptocurrencies. Decentralized apps. In recent years, blockchain has seen its applications in various sectors. Decentralization lies at the core of all its applications, and, in this context, it is important to understand the concept of decentralized apps. Decentralized apps, or dApps, are digital applications and programs that run on a blockchain of peer-to-peer networks instead of a single computer. As all transactions on a blockchain network, dApps are also free from the control of any central authority. Decentralized applications are being built on various platforms, including the Ethereum blockchain. They have found their use in sectors like gaming, social media, and finance. Any standard web application, like Uber or Twitter, is owned and controlled by an organization that has complete authority over the workings of the app. There may be multiple users, but the back end of the app is always controlled by a select group of people. As a user, you can download a copy of the app for interaction and send data back and forth to the main server of the company. Decentralized applications run on a blockchain network. For example, apps like BitTorrent run on a peer-to-peer network where multiple participants are consuming content, uploading files, or simultaneously performing both functions. Apps that run on a blockchain network are free from the control of any central authority and can interact directly with one another. Advantages. The biggest advantage of decentralized apps is that they protect the privacy of their users. Nobody needs to submit any private information to use the function provided by the app, unlike in most centralized applications. For instance, you cannot use Uber unless you provide your name, email address, and payment information. People who are in favor of free speech advocate for social media platforms developed through decentralized applications. This will prevent censorship of posts, since the underlying blockchain technology will prevent posts from being deleted or blocked in a decentralized social media platform. The blockchain interface provides a flexible platform for the development of decentralized applications. Disadvantages. Right now, the biggest disadvantage of dApps is that it is still in its early experimental phase, and there are serious doubts regarding its ability to be scaled. Since there are still many unknown variables, they are prone to problems. Moreover, Most centralized apps are universally popular because they provide a user-friendly interface. If dApps want to take over, they have to provide similar ease of use, which can become a challenge at this point. Once a dApp has been developed, it needs to undergo regular code modifications and security updates so that it can fix bugs and other issues. Developers of dApps believe this can become a problem since blockchain codes are difficult to modify. Examples of dApps. Peepith is a decentralized social network app that is similar to Twitter. A dApp game called CryptoKitties allowed users to trade virtual cats. Users of dApps usually pay the developers through cryptocurrencies for downloading the source code of the app instead of downloading a mere copy. These source codes are in the form of smart contracts, which help the users to retain their anonymity. Smart contracts take the application aspect of a blockchain to the next level. Chapter 4. Smart Contracts. In legal terms, a contract can be defined as a mutual obligation that is enforceable by law involving compensation in exchange for certain goods or services. For a contract to be formed, one party needs to make an offer that the other party will accept. In the United States, awareness is also an important part of a contract, which means that the parties must be on the same page about what they are getting into. Both parties should recognize the existence and genuineness of the contract and provide consent to the contents. Most contracts, even now, are physical, where the parties have to go through numerous pages of documents containing clauses and provisions. Lawyers of both sides are assigned to read through the entire documents to ensure there are no unfavorable conditions that they have to agree upon. The contracts are written in complex legal language that requires thorough verification from both parties. A few decades ago, contracts used to be relatively simpler. However, as the business world grows more dynamic, contracts and their applicability becomes more and more complex. Cross-country dealings are becoming increasingly popular, which is making physical contract papers obsolete. As digitalization is slowly taking over the world, many corporations are opting for contract automation, where they develop, store, and manage all their legal documents online. This can be used to create a direct link with their customers. Smart contracts are the next step in the journey of contract automation and are playing a pivotal role in the digitalization of various sectors of the economy. Breaking down smart contracts. In 1994, American computer scientist and cryptographer Nick Szabo was the first person to come up with smart contracts. He was the one who created a virtual currency called BitGold in 1998. He defined smart contracts as computerized transaction protocols that are capable of executing the terms of a contract. His objective was to extend the functionality of electronic transaction methods to the digital world. Szabo defined the execution of a contract for synthetic assets like bonds and derivatives in his paper. He wrote that many new securities could be formed by combining bonds and derivatives, like options and futures. According to him, complex payment term structures could be written into standardized contracts, and transactions could take place by incurring lower costs. He predicted a lot of things that eventually came true, like derivatives trading being conducted through computer networks. Link between smart contracts, blockchain, and cryptocurrencies. In today's context, smart contracts are programs stored on the specific blockchain network that run only when certain predetermined conditions are met. They are self-executing agreements where participants are immediately certain about the outcome without any time lapse or the involvement of an intermediary third party. Smart contracts can also be used to automate a workflow or process where the next step is automatically triggered on the meeting of conditions. Smart contracts are stored in the blockchain ledger, and the contract code is known in advance, which is why it cannot be altered by bad actors. These contracts are fast and execute anonymously, which helps in retaining their integrity. Many cryptocurrency networks, like Bitcoin and Ethereum, support smart contracts to automate functions within their network. How do smart contracts work? The fundamental code of all smart contracts is in the form of a simple if, when, then that is written into the blockchain. When these predetermined conditions are met, the network of computers in the blockchain executes the contract. They are called self-executing because nobody has to manually execute the contracts. It happens automatically on fulfillment of conditions. The actions in these contracts can include transferring funds to concerned parties, sending notifications, or registering any appliance or vehicle. Once the transaction is complete, the blockchain is updated and can only be reviewed by concerned parties. It cannot be changed. A smart contract generally has multiple stipulations that must be satisfied for the execution to be successful. That is why participants must agree on all the conditions and explore all possible scenarios so that a clear dispute resolution framework can be established. Benefits of smart contracts. Many enthusiasts believe that smart contracts are capable of replacing traditional contracts. In this context, let us explore the various advantages that smart contracts have. Once the specified conditions are met, the contracts are executed immediately. Smart contracts are digital, and since they are automated, there is no delay or errors that are often associated with manually filing the documents. This improves the speed, efficiency, and accuracy of the entire transaction. Smart contracts invoke trust and transparency within the system. There is no third-party intermediary involved with a smart contract, and encrypted records of the transactions are only shared among the concerned parties. Nobody will alter any information for their benefit, which creates a trustworthy environment. Blockchain networks are extremely difficult to hack. Because of the underlying consensus mechanisms, if anyone wants to alter any record, they will have to change the entire network, which is expensive and not feasible. Hence, smart contracts are much more secure than traditional contracts. Smart contracts save time and money by removing intermediaries who cause delays and charge high fees. Limitations of smart contracts. Smart contracts are still at the initial stages of development, and they suffer from the following limitations. A blockchain network is usually extremely difficult to change, so making modifications to a smart contract becomes a hassle. Correcting an error in the code of a smart contract can be a difficult and expensive affair. The principle of good faith states that a contract will be executed honestly, and nobody will take any unfair advantage by exploiting the terms. However, since smart contracts have to be written in complex codes, the final contract might turn out to be different from the initial agreement. This can create loopholes within a contract. Third parties are not eliminated in a smart contract. They might not be present directly, but they will still form a part of the system. For instance, a lawyer will still be required by programmers and code writers to help them understand the terms of the actual contract before they write it into a smart contract. Every contract contains vague terms and conditions. Most of the time, smart contracts cannot tackle these unclear terms, leaving room for error. Probable applications of smart contracts. Despite the limitations, smart contracts are slowly finding their way into various mainstream industries. Here are a few examples of sectors where smart contracts could be implemented. Government voting system. Smart contracts could make manipulating the voting system difficult by creating ledger-protected contracts, which are extremely difficult to decode. Healthcare. Blockchain can be used to store confidential patient records with a private key. Smart contracts can be used to search anonymously within those records where the search can only be conducted by authorized personnel. Hospital receipts stored on a blockchain can be produced to insurance companies as proof of service. Smart contracts can help in managing hospital inventory, supervising drugs, and other compliances, which often become cumbersome in traditional database management systems. Supply chain. The biggest disadvantage of a traditional supply chain is that it needs to pass through multiple channels and intermediaries before getting approved. The increased paperwork wastes time that can even lead to fraudulent activities. Smart contracts can remove these problems by providing secured digital versions of the relevant documents to the concerned people in the chain. They can also be used for inventory management and automating payments. Financial services. The entire financial sector can benefit from smart contracts in a multitude of ways. They can check and automatically transfer funds in the case of insurance claims, once they have checked the claim for any irregularities. In a traditional centralized system, claims often need to be verified physically by people before they are being processed. Smart contracts can play a pivotal role in bookkeeping by creating a robust accounting system where no transactions can be altered. They can also assist banks and financial institutions in speeding up clearing services, which is usually a time-consuming process. Vulnerability of smart contracts. Smart contracts can become instrumental in mitigating breaches. Theoretically, the idea seems to be excellent, but not all smart contracts can ensure absolute security. A smart contract is essentially a code following a specific algorithm, so it is prone to coding errors, bugs, and even hacks. Smart contract bugs can be very problematic and result in loss of funds. There have been many instances where users of smart contracts on networks like Ethereum have lost millions of dollars due to these bugs. A hypothetical scenario can also be imagined where hackers gain access to 51% of the system and try to manipulate the contracts. Although the chances of this happening are slim, this poses an important question relating to the possibility of reversibility of smart contracts. In 2016, there was an attack on the Ethereum blockchain where investors lost nearly $60 million. This attack happened due to a vulnerability in the smart contract. After a vote by the community, it was decided to reverse the transaction history from inception until the attack through a hard fork. To understand the vulnerability, let us expand on what happened. The Decentralized Autonomous Organization, DAO, consists of a group of people who write smart contracts that will run the organization. They offer tokens to people in lieu of funding. The holders of the token will have voting rights on the policies of the DAO, but no ownership rights. A DAO is present in every blockchain, including that of Bitcoin and Ethereum. Writers of smart contracts in a DAO know that if a blockchain was capable of moving large amounts of money, it would lead to a vulnerability in the network, and Ethereum was a victim of this problem. While the developers were trying to fix this issue, an unknown attacker began using this approach and began to drain the DAO of Ether collected from the sale of its tokens. Attempts were made to split the DAO and prevent Ether from being taken, but since voting was not possible within a short span, it was not feasible. Ultimately, it was fixed with the help of hard fork proposal by making alterations to the blockchain network. How can they be secured? As seen in the above instance, hard forks can be a way to reverse smart contracts. The original contract developer can allow modifications on the condition that the smart contract is replaced with a newer version, retaining the original terms of the contract. Apart from that, here are a few other ways to keep your smart contract secured. The best way to secure a smart contract is to write a clean and bug-free code for it. There must be enough testing to ensure there are no human errors, and this will increase the resilience of the smart contract's cryptography. A robust consensus mechanism secures an entire blockchain, and reflections of this security can be seen on the smart contracts as well. An active community enhances the functionality of the consensus mechanism and helps the smart contracts to stay secured. Evolution of smart contracts. Smart contracts have the potential to disrupt many industries because they create a unique environment where multiple concerned parties can interact with each other more efficiently. Despite the many possibilities, the limitations of a smart contract related to its security limit its scope to a certain extent. The legality of a smart contract. Smart contracts need to fulfill the requirements of a traditional contract if they want to be legally enforceable. The best way to do this is by joining a physical paper contract with a smart contract, which will enable the developer to add many provisions to the transaction. This will enable a business to improve its overall functionality by having a faster digital interface that is bound by traditional laws and regulations. California law already acknowledges electronic records and digital signatures as part of legal proceedings. Which companies are using smart contracts? For ensuring food safety, Walmart requires its lettuce and spinach suppliers to use blockchain. Other companies like Albertsons, Dole Food Company, Kroger, Nestle, Tyson Foods, and Unilever are adopting similar practices. Global banks like JP Morgan, Bank of America, Citibank, and HSBC have already adopted blockchain and are using it for various kinds of financial transactions. Multiple banks in China are also doing the same for improved operational efficiency, especially in the case of cross-border transactions. Now that you know about blockchain and smart contracts, we can proceed to the next part, where we will talk about crypto. Chapter 5. Cryptocurrency Mining. To truly understand how cryptocurrencies work, you have to understand how they're created. The process through which cryptocurrencies are created is called mining. Understanding mining. Mining is the process through which new cryptocurrencies are entered into circulation. It is also the process of adding new transactions and the blockchain's network's way of confirming them. Mining forms a crucial part of the maintenance and development of a blockchain ledger. When the blockchain is using a proof-of-work consensus mechanism, the mining process involves solving a complex computational problem, and the first one to find a solution is rewarded with making the next block and new tokens. Mining of cryptocurrencies strengthens the entire blockchain by recording a decentralized transaction and validating. Mining is a metaphorical term that refers to the work of solving complex mathematical problems by the nodes in a blockchain network in the hopes of earning new tokens. Mining of cryptocurrency using a proof-of-work consensus mechanism is a complex and expensive process. Despite all the hassles, many investors actively try to get into the business of mining because of the high rewards. Bitcoin miners receive their compensation in Bitcoin, and that is what makes this so attractive. Miners. In the early 2010s, anyone could purchase specialized mining hardware or use their own computer, connect it to the internet, and mine crypto. However, now there is a need for expensive and sophisticated mining hardware. Because of the potential for high rewards, Bitcoin mining has become very concentrated. There are currently 9 large corporations that mine approximately 85% of all Bitcoin. Many users that want to get into mining on a smaller scale pay a monthly fee and join a cloud-based cryptocurrency mining operation to participate in crypto mining. Mining pools. The probability that a miner will find a solution to the mathematical puzzle depends on their proportionate share in the total mining power. A miner having a small percentage of the mining power is less likely to find a solution and mine crypto. Individual miners represent a very small portion of the total mining power, and that is why getting a return on their investment becomes difficult. In such situations, mining pools can be a suitable option. These pools are operated by third parties, and they coordinate different groups of miners. The miners work together in groups and share the payouts, which allow them to earn a steady flow of cryptocurrency right from the time of activation. Miners help in preventing double spending. Crypto miners play a significant role in preventing the problem of double spending. Double spending is a phenomenon where a holder of a cryptocurrency illicitly uses the same currency twice for 2 different transactions. For physical currency, this can never be an issue. Once you use a $10 bill for buying candy, you part ways with that bill forever and can never use it again for buying something else. The goods are delivered when you physically pay the seller with that bill. However, somebody could make a copy of a digital currency and use it for some other transaction. This is very similar to using counterfeit bills. If somebody takes the pain of checking the serial numbers on the bills, they will be able to detect the fraud. Cryptocurrency miners perform a similar function and check the transactions to ensure that nobody spends the same token twice. The mining process. The first task performed by miners is listening to transactions on the blockchain network. They track the requests for sending and receiving cryptocurrencies and ensure that there is an input for every transaction. This means that if somebody is requesting to send 3 bitcoins, the miner will ensure that they have enough bitcoin to complete the transaction. Miners check the private keys and digital signatures of the recipients to ensure that they are authorized to receive cryptocurrency. They also check the tokens for double spending. Once everything checks out, the miner will add this transaction to a list of all valid transactions. This is a personal list, and every few minutes, a miner will be selected to add this list or a block to the official blockchain. This process ensures that the public record is always updated with the latest transactions. Miners in a proof-of-stake environment are chosen randomly by native coin holders of the network. Your node is eligible to become a node when you hold a certain number of coins in your wallet. Staking wallets are used by the miners to stake the required number of wallets. If a miner has 1% of the total number of coins, they will be able to mine 1% of new blocks. Let us see how the Bitcoin network ensures a corruption-free blockchain. In the Bitcoin network, miners are made to compete, and a new miner is made to write a new block every 10 minutes. A miner's block gets added to the network when the majority of the nodes agree that the following conditions are met. The transactions listed by the miner are valid and free from any fraud. The miners have correctly guessed the nonce. A nonce refers to a number or value that can be used only once. Bitcoin miners use trial and error to try to guess a valid nonce, which results in a hash that meets a certain requirement. The first miner to find a nonce that results in a valid hash is allowed to add the next block into the blockchain. This is a simplified description of the mining process, and you can delve into more details if you are interested. Mining and minting. When a new block is hashed in the Bitcoin proof-of-work network, it triggers the minting of new coins through mining. In proof-of-stake, coins are not minted through mining. They are minted through staking. In proof-of-stake, there are no miners. There are validators that create and check blocks. In summary, proof-of-work tokens are minted through mining, and in proof-of-stake tokens are minted through staking. Both create new tokens. So, the difference between mining and minting is actually a difference between proof-of-work and proof-of-stake. Tools required for mining. A miner needs to invest in powerful computing equipment, like a graphics processing unit, GPU, and an application-specific integrated circuit, ASIC. The prices of this equipment can start from around $500 and go up to thousands of dollars. Many Ethereum miners buy individual graphics cards as a low-cost option to combine mining operations. ASICs are mostly used for Bitcoin mining. They are more powerful than GPUs, having higher hashing power and energy efficiency. Limitations of mining. The limitations of mining lie in the financial and regulatory aspects. You can invest in expensive mining tools worth thousands of dollars without any guaranteed return on investment. Mining tools can mitigate this problem to a certain extent, but you must consider the regulations of the country you are residing in before you get into it. There are many places around the world where mining is still illegal, primarily due to energy concerns and adverse environmental impacts. Crypto mining consumes more electricity globally in a year than the annual consumption of a country like Finland. The legality of crypto mining. Due to the increasing energy concerns, many countries are on the edge of banning crypto mining. China took a stand by banning crypto mining in the latter half of 2021 to allow the CCP to maintain control of currency, which prompted many prominent miners to move to Europe and the United States. In 2022, Kosovo imposed an indefinite ban on mining because, in December of 2021, the country had to shut down its largest thermal power plant and is now importing electricity from outside. Other countries that have banned crypto mining are Nepal, Egypt, Pakistan, Algeria, Tunisia, Bangladesh, Qatar, and Oman. Having clarity on the concept of mining is an important milestone in your journey to understanding cryptocurrencies. This knowledge will help you as we move forward and try to understand more about what cryptocurrencies are. Chapter 6. Everything about cryptocurrencies. In the last few years, cryptocurrencies gained massive popularity. The value of the most popular cryptocurrencies have increased phenomenally, thereby providing huge returns to its investors. The hype around cryptocurrencies has invoked the interest of many people. By now, your knowledge about blockchains and mining has made you comfortable with the underlying technology and process of the creation of a cryptocurrency. Before we delve deeper, let's break down the word cryptocurrency. The crypto in cryptocurrency stands for cryptography. The literal meaning of the word crypto is secret or concealed, and cryptography means any writing that is written in a secret code that would be understood only by the receiver. Cryptographic technology aims to send secure and encrypted messages or data between concerned parties. The sender encrypts the message so that it cannot be understood by any third party, and only the receiver will be able to decode it. The use of cryptography makes cryptocurrency transactions secure, anonymous, and trustless. which means you don't need to know anything about the other person while making a transaction. Decoding cryptocurrencies. Cryptocurrencies are digital currencies secured by cryptography. They operate on the blockchain network, and their underlying consensus mechanism makes it almost impossible for anyone to counterfeit or double spend. Cryptocurrencies are not issued by any government or centralized authority, which means they are free from their manipulation. Despite being a part of the traditional economy, crypto follows its own rules and is immune from government intervention. There is no third party, like a bank, in a cryptocurrency transaction because blockchain allows the concerned parties to make the transactions freely. Do cryptocurrencies show any features of fiat currencies? History shows us that money continuously evolves, and right now, we are in the digital era where cryptocurrencies are the biggest sensation. Cryptocurrencies like Bitcoin or Ether work on the decentralized blockchain network and promote financial inclusion across the world. Despite their rising popularity, the question remains whether cryptocurrencies can be regarded as money. This comes down to the functions they are playing, and we get a clearer idea when we compare cryptocurrencies with traditional fiat currency. Utility. A currency must act as a means to pay, must not depreciate, and it must be fungible and able to be counted by separating it into smaller amounts to be considered as money. Money must retain its value for a considerable period in the future. If there is no stability, people will not be motivated to use money as a means of payment. Right from its inception, the cryptocurrency market has always been associated with validity, which means their value fluctuates highly. The value of Bitcoin fluctuates rapidly within days. In April 2021, Bitcoin's value was somewhere around $53,000, which fell to around $35,000 in May of 2021. The value exceeded $65,000 in November of 2021, only to fall by almost 50% within the next 3 months. Now, a new category of cryptocurrencies called stablecoins is emerging, where the value of these cryptocurrencies is pegged with an underlying asset, like a fiat currency or assets. These stablecoins eliminate the validity factor to a certain extent. We will cover stablecoins in detail in Chapter 10. Medium of exchange. Money must be accepted as a means of payment. Both parties of a transaction should share the same perception regarding the value of money, which is how a financial transaction takes place through fiat currency. Cryptocurrency is yet to take its place as a medium of exchange, but the rapid expansion of the network and introduction of new currencies is a step forward in this regard. In 2020, PayPal began offering U.S. account holders to trade cryptocurrencies like Bitcoin, Litecoin, Ether, and Bitcoin Cash. Unit of account. Government and central banks use monetary policies to value currencies concerning others. Money is printed or interest rates are raised to adjust the value of a fiat currency. Divisibility is also an important function of the unit of account. Just like a dollar can be split into quarters, dimes, nickels, and pennies, a cryptocurrency is also easily divisible because of its digital nature. For instance, you can choose to buy a Satoshi, which is 100 millionth of 1 Bitcoin. Derivation of value. The value of fiat currency depends upon the policies of the government. Fiat currency lacks intrinsic value, and it is valued according to its status as a legal tender. The native blockchain of a cryptocurrency determines its values. Monetary policies in a blockchain are more transparent and written into the protocol's code. Different cryptocurrencies derive their value in different ways. For example, Bitcoin derives its value from having a fixed maximum supply, 21 million. The scarcity makes it valuable. On the other hand, a stablecoin like the USD coin has its value pegged to the US dollar. Advantages and disadvantages of cryptocurrencies. Let us discuss the advantages and disadvantages of cryptocurrencies. Advantages. Due to the underlying blockchain technology, cryptocurrency transactions take place on a decentralized platform, eliminating the need for any intermediary to control them. It also gets rid of the problem of a single point of failure, like a bank server crash. Different systems like proof of work and proof of stake ensure the safe transfer of money without any third party. Public and private keys enable these transactions to take place easily and safely. The absence of third parties also enables smooth and faster transfers with lower transaction fees in many cases. Due to the volatile nature of cryptocurrencies, their value often skyrockets. That is why investing in cryptocurrencies can fetch a trader high profits if they can cash out while the prices are rising. Disadvantages. The anonymity of cryptocurrency transactions is not entirely true, and they can at best be regarded as pseudonyms. They leave a digital trail that can be deciphered by high-level organizations like the FBI, which can allow them to track regular transactions of ordinary citizens. People with questionable motives conduct illicit transactions through cryptocurrencies on the dark web. The dark web is the section of the internet that is not indexed by search engines and requires special software or authorization to access. Hackers use crypto for ransomware activities. This raises questions about its security. In theory, anyone with a computer and internet connection can mine a cryptocurrency. However, it requires very expensive hardware and consumes huge energy that can only be afforded by large corporations. Cryptocurrency trading is mostly speculative, and the gains can be short-lived if an investor does not cash out at the right time. Uses of cryptocurrencies. Currently, most people view crypto as a sort of investment, like stocks and bonds. It has not yet become a medium of exchange, but there are a few instances where you can use cryptocurrency as money to buy goods and services. Some tech companies like Newegg.com, AT&T, and Microsoft accept crypto as a means of payment on their website. Overstock is an e-commerce platform that was one of the first companies to accept Bitcoin, and was followed by Shopify, Rakuten, and Home Depot. Luxury retailers like BitDials offer high-end watches like Rolex and Patek Philippe for Bitcoin. High-end luxury car dealers accept cryptocurrency as payment. In April 2021, Swiss insurer AXA announced to accept Bitcoin for all insurance policies except life insurance. Coins versus tokens. In the context of cryptocurrencies, coins and tokens are terms that are used frequently and interchangeably. However, the two are different in many aspects, and it is important to be aware of these differences. A crypto coin is created on its own blockchain and can act as a digital currency. It is comparable to traditional money because it has a store of value and can be used as a medium of exchange. Examples of coins are Bitcoin and Litecoin. Tokens can also be used as digital currency, but have a wider scope. They are created on top of an existing blockchain and can be used as a part of a software application. Here are a few uses of tokens. They can be used to verify identity, grant access, or track products on a supply chain. Tokens can also be used to represent digital art in the form of non-fungible tokens, covered in Chapter 8. Ether is an example of a token that conducts its transactions on the Ethereum blockchain. Tokens can be used as a means of payment to buy goods and services. Governance tokens are used to give their holders voting powers on a blockchain project. Polkadot is an example of a protocol enabling blockchains to operate together. Holders of DOT vote on various staking and validator parameters. Tokens can be used to allow token holders to stake their tokens in exchange for financial rewards. They are also used to grant ownership rights of an asset. Cryptocurrency wallets. Cryptocurrency wallets enable users and investors to interact within a blockchain network. These wallets do not store the cryptocurrency, but act as a medium through which transactions can take place. They help in generating essential information, which is useful for sending and receiving cryptocurrencies. Pairs of private and public keys are used to generate an alphanumeric identifier called an address. The address is a lot like your home address. It specifies your location on the blockchain network where cryptocurrencies can be sent. The cryptocurrency transfer takes place within the blockchain, and your private key gives you access to all of your funds. Cryptocurrency wallets can be hardware, software, paper, and they can be further classified as hot or cold. Hot and cold wallets. Hot wallets are those that are connected to the internet and are user-friendly. However, due to their constant connection, they often pose security threats. These wallets can be conveniently used by traders for conducting daily transactions. Cold wallets are offline, hack-resistant wallets that ensure a high level of security and are more suitable when you are holding your cryptocurrencies for a long period. You can compare a hot wallet with a wallet that you carry around with you, while a cold wallet is like a safe that stores all your valuables in bulk. Hardware wallets. These are hardware devices that individually handle the public and private keys. It resembles a USB device with an OLED screen and buttons on the side. You can connect a hardware wallet to your computer, and it does not require any battery to operate. They are safe and offer a certain degree of control. Paper wallets. A paper wallet is a physical copy of your public and private keys that is generated by a website and printed on paper. Since it is not digital, there is no problem with hacking. This method was quite popular in the early years of cryptocurrencies, between 2011 to 2016, and is now becoming obsolete due to the various disadvantages like vulnerability from water or fire damage and theft. If someone gets a hold of the paper wallet and has access to the private key, they can steal all the crypto held by the owner of the wallet. Desktop wallets. Desktop wallets are installable software packages that are perfectly suited for offline storage of cryptocurrencies. They provide anonymity and do not involve any third party. Desktop wallets are evolving and show potential for storage of cryptocurrencies. Some examples of desktop wallets are Exodus, Bitcoin Core, and Electrum. Mobile wallets. These are mobile versions of desktop wallets and can be conveniently used on the go to make transactions through QR codes. However, they are not secure and are open to malware attacks and viruses. Coinonomy and Mycelium are examples of mobile wallets. Web wallets. Web wallets are accessed through internet browsers, but are not the same as hot wallets. These wallets are prone to attacks. They are only preferable for transactions dealing with small investments. Sources of cryptocurrencies. Cryptocurrencies are unlike any other asset we know of, and are not available in stores or even e-commerce platforms. As discussed in the previous chapter, mining is an option for earning cryptocurrencies, but that is not a feasible option for most people. Cryptocurrency exchanges. Crypto exchanges function similarly to stock exchanges. Coins and tokens are available on these exchanges, and investors can easily trade in them. Some of the popular cryptocurrency exchanges are listed as follows: Coinbase and Coinbase Pro. Coinbase offers a wide choice of cryptocurrencies to its users. Coinbase Pro is an advanced version of the same platform. Cash App. This is a suitable platform for beginners because it provides a simple interface like Venmo and other money transfer apps. The main feature of this app is a money transfer that allows you to split bills and rent. Cash App has a basic cryptocurrency trading platform. Bisq. This is a simple decentralized platform that does not have any Know Your Customer requirements. It also has a mobile app compatible with both Android and Apple. Binance US. This platform gives an option of hundreds of cryptocurrencies to trade in. They also provide advanced charting and reports. Investment options. In addition to purchasing tokens on an exchange, there are other investment options. Initial coin offering. This is similar to a company issuing shares in an initial public offering, where a company issues shares to the public for the first time. A share in a company represents ownership, which is limited to the value of the share. For instance, if you buy shares worth $100 in a company, your ownership is limited to that $100. Instead of shares, your company issues cryptocurrencies to raise funds. You can buy the crypto token that the company is offering. The token can be linked with the goods or services provided by the company or represent ownership in the company or project. Usually, the promoters of the company publish a white paper on the official website, specifying all the details in the ICO. Anybody who has access to the technology can launch an ICO, and this sector is not under much regulation. Initial exchange offerings. In recent years, ICOs have lost their popularity and have been replaced, to a great extent, by initial exchange offerings, or IEOs. IEOs undergo a great level of scrutiny and due diligence, which makes them safer than ICOs because of the active involvement of exchange platforms. These exchange platforms are generally well-established brands, which make the crowdfunding model more trustworthy. Initial DEX offerings. When a company launches a project through a decentralized exchange, or DEX, it is known as the initial DEX offering. IDOs have similarities with IEOs. In an IEO model, the tokens are launched on a centralized platform, and in a DEX model, the tokens are launched on a decentralized platform, which allows for greater control of your launch. In a centralized exchange, the project creators have to pay significant amounts of tokens to the platform. They have to follow strict guidelines, and there are exclusivity rules to follow. IDOs, on the other hand, can offer a simpler and more cost-effective listing model. Security token offering. A security token represents a stake in an external asset or company. Governments and companies can issue security tokens that function similarly to stocks and bonds. Security tokens are highly regulated by various statutory bodies across the world, providing greater security to investors. In an ICO, investors receive tokens which do not represent physical ownership of an asset. They are considered utility tokens and have some value on that particular platform. In comparison, in an STO, the tokens represent ownership of a real asset, such as real estate. Cryptocurrency transactions. Once you are aware of your risk appetite and financial priorities, you can start thinking about investing in cryptocurrencies. Since there are many options, you should think carefully before investing. How to buy cryptocurrencies. Purchasing cryptocurrency is different from all other products known to us. This is a simple step-by-step guide to make things a bit easier. Step 1. Choose an exchange. If you wish to invest in cryptocurrencies, the first step would be to select an appropriate exchange to do so. Cryptocurrencies are currently not available in traditional banks, so you have to make your transactions through a cryptocurrency exchange, where you can exchange your US dollars for crypto. The amount of crypto you can purchase will depend on the valuation of the currency you are buying as of that date. Before choosing an exchange, you should consider the following factors. Security. Since investments in cryptocurrencies is not backed with guarantees from centralized institutions, like FDIC, you should choose a reliable exchange where there is minimal risk of your account being hacked. If a crypto exchange is hacked, your account could be compromised, and you may lose your investments. Fees. Fees on a crypto exchange vary greatly and are often linked with market volatilities. However, you should not just be looking to save money. Security and the quality of the exchange must be considered, even if it means paying higher fees. Coins available. Not all coins are available in every exchange, so make sure your chosen exchange has the coins you want to buy. Step 2. Fund your account. Most of the exchanges require certain personal details, like a social security number or source of income, while creating an account. Once you are all set up, you can connect your debit card or bank account so you can transfer dollars. Adding funds is not the same as buying crypto. You still need to place an order and exchange money for cryptocurrency. Step 3. Place an order. The next step would be to place an order for the crypto you wish to purchase. If you are using a platform like Coinbase or PayPal, you can enter the dollar amount with which you wish to purchase your desired crypto, and the exchange will take place thereafter. For more active traders who use platforms like Coinbase Pro, there is an option to place a market order or a limit order. For a market order, you will be buying crypto at the current rate of the moment at which you are making the purchase. In the case of a limit order, you can set a price, and once your desired currency reaches that price, you will be able to make that purchase. Step 4. Store your crypto safely. As your portfolio grows, you should make it a point to transfer it to a wallet that can keep your investment safe. There are certain platforms that do not allow moving cryptocurrency to a wallet. Before choosing an exchange, make sure this is something you are comfortable with. Tips for crypto transactions. Here are a few useful tips you can remember while you are transacting or investing in cryptocurrencies. Start small with your investments. When you are purchasing crypto, try to place a small order first, just to get the hang of the process. This is true for sending crypto to someone as well. Before sending a lot of crypto, send a small amount to the address to make sure everything is in order. Even if there is a problem, you won't be losing much. When you are sending coins or tokens between exchanges, make sure you follow all the directions properly. There might be very specific instructions. Transactions can be processed instantly, but if the traffic is high, it might take a while. Do not panic, because most crypto exchanges show you a list of your pending transactions. Your transaction will also be added to the coin's public blockchain, and so an encrypted version will always be available to you. Scams to watch out for. The cryptocurrency ecosystem is famous for scams where people have lost millions of dollars. Before you invest, beware of these common scams. Fake websites are filled with false testimonials of huge returns. The objective is to inspire you to keep investing in crypto through this website. And then, the website would suddenly close down and your money would be lost. There are many virtual Ponzi schemes where you'll be given information about unique opportunities related to crypto investments and involve more people under you. A Ponzi scheme is a fraudulent investment scheme that entrapps investors and pays the earlier investors from the profits earned from the more recent ones. There are no legitimate business activities, and the source of funds comes from the new investors. Scammers often pose as popular celebrities and endorse a certain cryptocurrency. When many investors get hooked and the price has been driven up, the scammers sell their stakes and the crypto goes down in value. Crypto scams related to online dating have become increasingly common in the past few years. Here, scammers try to persuade people they have met in dating apps or social media to invest in cryptocurrency. In October of 2021, a new crypto called Squid Game was introduced into the market, based on the popular Korean TV series. The coin was offered through a play-to-win game, and to enter, you needed to purchase certain units of the coin. The coins could only be redeemed after you completed a few levels of the game. The show was very much in hype at the time, and many obsessed gamers invested in it. Subsequently, the coin rose phenomenally, and it all turned out to be a scam because there was no game to begin with. The players would never be able to redeem the units because the condition for redemption was not valid. Currently, there are thousands of cryptocurrencies in the market. If you decide to invest in them, you must have ample knowledge about what they are and how they work. Otherwise, you might end up getting scammed. Bitcoin is the most popular cryptocurrency, followed by Ethereum and many others. We will discuss them in detail in the coming chapters. Chapter 7: The Bitcoin Phenomenon. Any discussion about English rock and roll music is incomplete without the mention of the Beatles. Similarly, any book on cryptocurrency will not make sense if we don't talk about Bitcoin. Bitcoin was the first cryptocurrency, introduced to the world more than a decade ago, and is now taking over the entire economy by storm. Bitcoin had a humble beginning, but its progress has been steady, and it has survived many highs and lows. In this chapter, we will explore how Bitcoin came into existence and other important details about the most popular cryptocurrency. History of Bitcoin. In 2008, an individual or group of people named Satoshi Nakamoto released a white paper specifying the details of Bitcoin. The original Bitcoin software was released in 2009. It feels mysterious and fairy tale-like to think that one person emerged out of the blue and created something extraordinary like Bitcoin. However, by now, you are aware of the effort and technology required to create cryptocurrencies, and you can understand that it could not have been the effort of a single person. To date, the identity of Satoshi Nakamoto is unknown, although many people have claimed the identity. Bitcoin started as an aftermath of the financial crisis of 2008 that had devastated the American economy. The white paper published by Nakamoto addressed the issues with centralized control of money and highlighted the importance of trust and transparency within a financial system. Bitcoin was projected as a means of making payment without the need for a third party or centralized network. The white paper claimed that Bitcoin would use cryptographic proof and maintain the integrity of the transactions. Earliest Bitcoin transactions. The Genesis block, or the first block, was mined on January 3rd of 2009, and that was when the first blockchain was launched. The first Bitcoin transaction took place on January 12th of 2009, when Satoshi Nakamoto sent 10 Bitcoins to famous cryptographer Hal Finney. Choosing Hal Finney was not a surprise, because he had done exceptional work in the world of programming and cryptography. He also laid the groundwork for usable proof of work that would later be developed into the most popular consensus mechanism of the blockchain network. During the early years, Bitcoin had no monetary value. In 2010, Laszlo Hanyecz spent 10,000 Bitcoins to buy himself a couple of pizzas from Papa John's. This is still regarded as a legendary transaction because if he had held on to those Bitcoins, they would have been worth hundreds of millions of dollars. The transaction took place on May 22, 2010, and crypto fans all over the world celebrate this day as Bitcoin Pizza Day. Important issues related to Bitcoin. Like any other cryptocurrency, Bitcoin uses cryptography to keep it secured. There are no physical Bitcoins, and all transactions are recorded on the public Bitcoin blockchain. The transactions are visible, but the identity of the people making those transactions remains hidden, making it an anonymous and transparent platform. Bitcoin works on a proof-of-work consensus mechanism, which means to make an addition or alteration to the network, a node would require a consensus from the majority of the nodes on the network. The number of nodes on the Bitcoin blockchain is rapidly rising, and it currently stands at more than 10,000. Bitcoin miners can be regarded as a decentralized authority to whom the Bitcoins are issued at a periodically declining rate. The total number of Bitcoins has been fixed to 21 million, which means there cannot be more than 21 million Bitcoins in circulation because creator Satoshi Nakamoto put a cap by regulating it through an algorithm in its source code. Decentralization invokes trust. Due to its decentralized nature, everyone is keeping an eye on everyone else on the Bitcoin network. Everyone can see the status of the blocks and the transactions that are taking place without disclosing their identity. Decentralization ensures the absence of any centralized authority, like the government or a third party like a bank. Any transaction on the Bitcoin network can be conducted by people directly. Uniqueness of Bitcoin. The process of Bitcoin mining prevents double spending and ensures fraudulent transactions are not entered into previous blocks. Bitcoin was not the first digital currency. In 1997, Adam Back introduced Hashcash, which could be considered as a precursor to the current cryptocurrencies. However, combining proof of work with these cryptographic techniques was the breakthrough that set Bitcoin apart. A 1 megabyte block of transactions can be processed by a network every 10 minutes, and Bitcoin software adjusts any difficulty that the miners may face in this regard. This helps the network to handle the volume of transactions by providing time to verify the new block and reaching a consensus to maintain a status quo. The halving. You already know that miners receive their rewards in cryptocurrencies for adding a block to the blockchain. After every 210,000 blocks have been mined, the rewards are cut in half. This event occurs roughly every 4 years and is known as halving. The system is designed in such a way that the circulation rate of Bitcoin keeps on declining over time. At the current rate, miners will get rewarded for Bitcoin mining until the year 2140. Once all the Bitcoins have been mined and the halvings are complete, miners will receive transaction fees from the user of the network as their reward. Through this method, the stock-to-flow ratio for Bitcoin is driven up, and inflation is lowered until it reaches zero. In 2009, miners would receive 50 bitcoins for every block mined. After the first halving, it became 25, and then 12.5. As of May 11th, 2020, the reward for mining a block is 6.25 bitcoins. Segregated witness. A change in the transaction format of Bitcoin is referred to as segregated witness, or SegWit. There are thousands of nodes on the Bitcoin blockchain that act as validators for the blocks created by the miners. As the transaction volume increased, more blocks were added to the network every 10 minutes, which needed to have a maximum size of 1 megabyte. The blocks started weighing down on the network, slowing transaction speed. Sometimes it would take hours to validate a transaction. As cryptocurrencies increased in popularity and more people started trading in them, SegWit was implemented to maintain the transaction speed. Bitcoin developer Peter Wella formulated the concept of SegWit. SegWit divides the transaction into two parts by separating the unlocking signature from the original portion. This unlocking signature is also called the witness data, and it stays on a part of the blockchain as a separate structure at the end. The sender and receiver data is held by the original portion, while the witness data contains the scripts and signatures. This segregation frees up space and provides room for faster processing of new transactions. SegWit makes the blockchain more secure by addressing the issue of malleability, which means altering small bits of information on the blockchain. SegWit is a form of a soft fork. It leads to the implementation of Taproot, which is an upgrade to Bitcoin that facilitates much faster validation. Things that you should remember about Bitcoin. It is important to remember these few things. Security is your responsibility. You must adopt good practices to secure your Bitcoin wallet. The wallets let you transfer Bitcoin anytime and anywhere, giving you complete control of your money. However, these benefits also expose you to security threats. Blockchain as technology offers you very high levels of security, and if you are using the wallets correctly, you can utilize these features optimally. It is advisable to not store all of your Bitcoin in your online wallet and invest in a cold wallet as your portfolio grows. You should not disclose your password to ensure confidentiality. Irreversibility. You cannot reverse a Bitcoin transaction. Only the receiver can refund you themselves. This is why you should choose the people you do business with carefully and only opt for established entities with a good reputation. Bitcoin can detect typos, so there is no risk of sending them to an invalid address. But you can send the crypto to a wrong address. If the receiver does not send you back your crypto, it is gone forever. Protect your privacy. Bitcoin is not anonymous, and you need to take steps to protect your privacy. Since blockchain is a public network, all Bitcoin transactions are stored and can be viewed by anyone. However, this record does not disclose the identity of the person making the transactions. You should not disclose any personal or sensitive information during the transaction so it doesn't become public. Government taxes. Bitcoin is not yet an official currency, and most governments across the world treat it as a digital asset or an investment that you are holding. That is why you need to pay capital gain taxes on Bitcoins in most countries. If you are actively trading in Bitcoin, you must know about the government rules, regulations, and taxation requirements. Bitcoin is volatile. Because of its developing nature, Bitcoin is highly volatile and has exhibited some of the highest fluctuation rates since its inception. When Bitcoin was introduced in 2009, it was not worth anything. In 2010, it was valued only at 9 cents. In April of 2011, Bitcoin's value reached $1, and within 3 months, it showed an increase of 2,960% by rising to $29.60. However, this gain was temporary, as the prices fell again later that year. After an uneventful 2012, Bitcoin prices reached $1,237 in December of 2013, but fell by almost 45% within the next 3 days. Prices kept on falling throughout 2014 and 2015, but by the end of 2016, Bitcoin prices were again on the rise, touching almost $900. By December of 2017, Bitcoin prices had skyrocketed to $19,345. After that, prices were again fluctuating and even came down below $10,000. At the beginning of 2020, Bitcoin was valued at $6,965 and showed a 416% increase by reaching $29,000 in December of 2020. In 2021, Bitcoin continued a bull run, with frequent price increases even reaching $68,990, which is its highest value to date. Prices have fallen since then, and in 2022, Bitcoin values are hovering around $40,000. The purpose of describing the entire Bitcoin price timeline was to make you aware of the volatility of this market. The cryptocurrency economy is still young. Despite being the most popular cryptocurrency, Bitcoin has its share of risks and vulnerabilities. However, these problems should not stop you from investing in cryptocurrencies. Chapter 8: Altcoins. Diversification is the key to earning returns in any investment portfolio. You should never put all your eggs in one basket. Explore all your options based on your financial situation and risk tolerance level. The emergence of Bitcoin stirred up controversy and ignited the interests of many. The unique nature of massive returns attracted people to become a part of this market and create new cryptocurrencies. That is how altcoins came into existence. Although Bitcoin still holds the majority of the market share in the cryptocurrency market, altcoins are emerging to be another option worthy of our attention. Understanding altcoins. The term altcoin has come from the words alternative and coin, and describes cryptocurrencies that are an alternative to Bitcoin. Altcoins have certain similar characteristics to Bitcoin, but exhibit differences by using different consensus mechanisms or functionalities. There are currently over 14,000 cryptocurrencies, and Bitcoin makes up the majority of the market share in terms of value, followed by Ether. The rest is made up of different altcoins. Essentially, altcoins have been derived from Bitcoin, so they often follow the price movements of Bitcoin. However, financial analysts believe that as the cryptocurrency ecosystem evolves, altcoin prices will become more independent. Altcoins were developed to overcome the shortcomings of Bitcoin, and many of them have successfully done so to a great extent. They have the same framework as Bitcoin, but many altcoins use the proof-of-stake consensus mechanism, which is a more energy-efficient way to create and validate new blocks. Ether is an altcoin that has achieved the position of the second largest cryptocurrency. Types of altcoins. Altcoins can be segregated into the following categories depending on their consensus mechanisms and functionalities. Mining. These altcoins are mined into existence, and most of them use a proof-of-work consensus mechanism. Litecoin, Monero, and Zcash are examples of mining-based altcoins. These altcoins are very similar to Bitcoin in their structure and technology. Stablecoins. The massive fluctuations in Bitcoin prices make it clear that validity is its biggest issue. To mitigate this problem, stablecoins were introduced. Stablecoins are altcoins that have their values pegged to an underlying asset. The underlying asset acts as a security. Examples of stablecoins include the USD coin, Tether's USDT, and Maker's DAO's DAI. Payment processing giant Visa Incorporated announced in 2021 that they would be processing certain transactions in USD coins on the Ethereum blockchain, thereby taking a step to making stablecoins a part of the payment processing space. In 2022, we saw the stablecoin Terra USD crash below its $1 peg. Stablecoins are less volatile, but their peg to an underlying asset is not guaranteed. Security tokens. We already covered security tokens in Chapter 6. These tokens are similar to shares and promise equity in a company or income in the form of a dividend payout. Security tokens are expected to appreciate over time because they offer equity in a company. As the company grows, the token will also grow in value. In 2021, the Bitcoin wallet firm Exodus completed a Securities and Exchange Commission-qualified Regulation A+ token offering and sold $75 million shares of common stock to be converted to tokens on the Algorand blockchain. This was particularly significant because it was the first time a digital asset had offered equity in the United States. Meme coins. Meme coins are inspired by memes, or silly jokes that become viral on the internet, usually for a short span. These altcoins are often promoted by online crypto enthusiasts, which drives up their value. The creators exploit short-term gains, and then the coin often goes out of circulation. These coins are often part of scams as well. Whenever Elon Musk posts about meme coins like Dogecoin or Shiba Inu, their prices rise significantly. The price of Shiba Inu rose 91% within a day when Musk tweeted a picture of Floki, his Shiba Inu puppy, on a Tesla. Utility tokens. These are tokens that can be used to provide services within a network. Utility tokens can be utilized for purchasing services, paying network fees, or redeeming rewards. They are not like security tokens because they do not provide dividends or ownership rights. Filecoin is a utility token that allows its holder to purchase storage space on a network. Pros and cons of altcoins. Although altcoins were created as an alternative to Bitcoin, comparing the two would be unfair because altcoins are still at the very early stages of development. They are not regulated and often have massive fluctuations. Let us look at the pros and cons to have a better understanding of altcoins. Pros of altcoins. Altcoins were created to remove the potential disadvantages of Bitcoin. They can be regarded as better versions of cryptocurrencies. Many altcoins using proof-of-stake consensus mechanisms have successfully reduced energy consumption and transaction fees. Altcoins can be used as a medium of exchange, like Bitcoin. Ethereum's Ether and Cardano's ADA are altcoins that are being used in mainstream institutions like Samsung Group, Microsoft, and JP Morgan. This has increased their value to a great extent. Cons of altcoins. The market share of altcoins is very low. Bitcoin is the leader in the crypto market, holding over 40% of the total market share to date. This means that majority of altcoins have a negligible share and do not influence the crypto market. The lack of regulation contributes to the low liquidity levels and subsequently makes altcoin prices even more volatile than that of Bitcoin. This volatility attracts fewer investors. Less popular altcoins are very risky investments and can aggressively fluctuate in price, which makes them very lucrative if you get in and out at the right time. This is why many investors are still focused on Bitcoin for the long-term investments. Popular altcoins to invest in. As an investor in altcoins, you have thousands of options. Here are a few options which have been in existence for a while and have found their application in a variety of sectors. Ethereum. This is the largest cryptocurrency to date and has become very popular, almost like Bitcoin. Ethereum is the first to introduce smart contracts and run dApps through its network. The Ethereum network is one of the most highly functional networks, and the currency Ether has shown a lot of promise on the applications on this network. Solana. Solana was primarily developed to support decentralized finance and dApps through smart contracts. It runs on a hybrid proof-of-stake and proof-of-history mechanism, which enables quicker and safer transaction processing. Its value has been rising steadily since coming into circulation. Polkadot. Many cryptocurrencies use multiple blockchain networks. The main function of Polkadot is to combine the various blockchains so that they can work together and contribute to higher efficiency. This can bring about a revolutionary change in the working of cryptocurrencies. It grew rapidly in the last half of 2021. Cardano. Cardano was one of the earliest cryptocurrencies to have adopted the proof-of-stake mechanism. This results in faster transaction processing. Cardano showed modest growth in 2021 compared to its competitors. Binance Coin. Binance is one of the biggest crypto exchanges in the world, and Binance Coin is the cryptocurrency that can be used to trade on this platform. However, it can now be used for trading, payment processing, and even booking travel arrangements. Since its inception in 2017, it has risen 377,000% through February of 2022. Stablecoins that you can consider. Here is an example of a stablecoin that has attracted market attention. US dollar coin. 1 USDC is equal to 1 US dollar and is powered by Ethereum. Cryptocurrency prices are very unstable, and it is more so in the case of altcoins. That is why, before investing, you should do your research and make the decision accordingly. Bitcoin and altcoins may bring revolutionary changes to the cryptocurrency ecosystem in the future. They are playing an important role in strengthening the blockchain network, thereby facilitating its entry into the various sectors of the economy, particularly finance. Decentralized finance has been highly impacted through the introduction of altcoins, and it is important to know how they work. Chapter 9. Decentralized Finance. The emergence of blockchain has shown the world what a decentralized system can look like. A radical change from the traditional and centralized sector to a peer-to-peer financial system enabled by decentralized technology may be the future. Understanding DeFi. Decentralized finance, or DeFi, is a new financial technology based on a distributed ledger system, similar to that of cryptocurrencies. It is still an emerging concept and aims to completely remove the control of banks or other intermediaries in any financial transaction. Most decentralized finance applications are built on top of Ethereum and facilitates a variety of services like lending, borrowing, and stablecoins. The DeFi ecosystem has an expansive network of financial instruments and integrated network protocols that increase the efficiency of the financial system as a whole. Decentralized finance makes the best use of smart contracts on the Ethereum network and has emerged as one of the most active sectors on the blockchain. It provides a wide range of products suitable for individuals, corporations, and promoters. DeFi optimizes the use of crypto assets by using them in ways where fiat currency falls short. DeFi products like decentralized exchange, flash loans, and others are unique products that can only function through a blockchain network. Difference between centralized finance and DeFi. To understand the difference between DeFi and centralized finance, let us look at how each of them works. It can take days for a bank to process a loan, even if all the documents are submitted and requirements are met. Moreover, there might be problems in using a bank's network while you are traveling to a different country. On the other hand, DeFi allows its users to make transactions seamlessly from anywhere. The underlying blockchain technology ensures that there are no intermediaries. They use a consensus mechanism to verify the data that is being entered into the system, to ensure safety and data integrity. Loans are processed faster, and users have more control over the transactions. Users enter their information in a dApp, and an algorithm matches you with a relevant peer that meets your needs. You simply need to agree to the terms, and the funds are dispersed after proper verification. The blockchain records the transaction, and, at frequent intervals, when you use a dApp to make the repayments, the funds are directly transferred to your lender. Stable coins are being used across DeFi platforms for remitting payments, lending, borrowing, and even for institutional applications like central bank digital currency. Advantages of DeFi. DeFi uses the main features of various blockchain networks to optimize its process and increase financial security and transparency. The following advantages of DeFi are important to note. DeFi uses highly programmable smart contracts that enable automation and help in the creation of new digital financial instruments. The underlying blockchain and consensus mechanisms ensure that the data remains tamper-proof. DeFi protocols use Ethereum's composable software stack. DeFi protocols use Ethereum's composable software stack to build complementary applications. This enables developers to build flexible systems that can be created on top of existing protocols. DeFi allows rich data analysis by acquiring relevant data. The underlying blockchain network provides transparency by having a distinct consensus mechanism. DeFi has open and permissionless access to everyone with a crypto wallet and an internet connection. Unlike centralized finance, there is no need for formal request or a minimum fund requirement. Disadvantages of DeFi. Following are the disadvantages of decentralized finance. If the blockchain hosting the DeFi project is not stable, then the whole project will automatically become unstable. If the underlying smart contract has any problem in its code, then the project will inherit these problems. DeFi use cases. DeFi has unlocked a new world of economic activity and opportunity for all users around the globe. It is actively being used in asset management, data analytics, gaming, compliance procedures, infrastructure tooling, decentralized exchanges, payments, and many other areas. DeFi lending and borrowing are the most widely used applications of DeFi. Compound allows autonomous interest rate calculation and integrates itself with other platforms like Pool Together, Argent, and Dharma. Compound provides an interest rate market on the Ethereum network, and, as a result, users can earn interest on the crypto that they have provided to a lending pool. Liquidity pools in decentralized finance. A liquidity pool creates a pool by throwing funds in a big digital pile. It is one of the fundamental technologies defining the current DeFi system. They are particularly important in the case of decentralized exchanges. Users can pool their assets in a smart contract of a DEX, which would provide asset liquidity for traders who are swapping between currencies. Liquidity is a measure of how easily an asset can be bought or sold on an exchange. Liquidity pools provide liquidity and speed to the DeFi system. They also encourage yield farming. In yield farming, you will be moving your idle crypto to liquidity pools to maximize your returns. Liquidity pools provide incentives to the users by asking them to provide their crypto assets in return for a share in the trading fees. This creates a win-win situation for everyone. Examples of liquidity pool protocols are Bancor and Uniswap. These platforms do not require buyer and seller matching. Buyers and sellers can simply exchange their tokens by using liquidity provided by other users. The entire transaction takes place with the help of a smart contract. Chapter 10: Trading in Cryptocurrencies and NFTs. Cryptocurrency has given the world many millionaires and even some billionaires. People have made a fortune. However, putting up a major chunk of your money may not be a wise option. When we talk about investing in cryptocurrencies, Bitcoin always comes to mind. It is the earliest crypto and has stuck around, despite extreme fluctuations. Investing in Bitcoin is relatively safer because it has a distinct position in the market. That being said, the price of Bitcoin can fall drastically despite its popularity. Altcoins can provide a good investment opportunity if you are cautious with your choice. Although the market for altcoins is still nascent, there are many tokens available on popular cryptocurrency exchanges. Altcoins have attracted many retail investors who aim to earn short-term profits by exploiting the rapid price fluctuations. Cryptocurrency markets have often been compared with the Wild West, where there are no regulations and anyone can make decisions without the fear of consequences. If you feel anxious venturing into these unsteady waters but still want to have a taste of what it feels like, you can consider investing in stablecoins. Since they are backed by a bundle of goods or fiat currencies, their value will be more stable. Apart from cryptocurrencies, NFTs are another class of digital assets that are rapidly gaining popularity and can be a suitable investment if you do your research. Understanding NFTs. NFTs are one of the biggest hypes in the digital asset space right now. However, like most things related to this space, most people have no idea what they are. A non-fungible token, or NFT, is a digital asset that represents some real-world object like art, video clips, or in-game items. They are usually traded in cryptocurrencies and have the same underlying software as crypto. NFTs have been around since 2014, but recently they have gained popularity as a medium of buying and selling digital art. Every NFT has a unique identifying code that makes them one of a kind or extremely rare and creates a kind of digital scarcity. They are completely different from all other digital creations which have ample supplies. Some NFTs have been created out of elements that are already available on the internet in some other form, like iconic clips of NBA games. This raises an important question as to why someone would pay thousands or sometimes millions of dollars for something already available. The answer lies in the ownership condition. When you screen record a basketball game, you are obtaining a copy of it. But when you buy an NFT, you own the original clip. This simple difference is what increases the value of NFTs, and passionate people of sound financial means are willing to pay millions of dollars to become the owner of that original piece of art. How is an NFT different from crypto? NFTs are drastically different from cryptocurrencies. The only similarity is the underlying programming, like Bitcoin or Ethereum. The fungibility of a currency means that it can be exchanged or traded for one another. $1 is always equal to another dollar, and one Bitcoin is equal to another. Cryptocurrencies are fungible, which is what makes them extremely suitable as a medium of exchange. However, NFTs are non-fungible, which means no two NFTs are alike. How do they work? NFTs are held on a blockchain network. Ethereum is the most popular network to hold NFTs, although many other blockchains provide this facility as well. Other popular blockchains are Cardano and Solana. An NFT is said to be minted from real-life objects that can include art, GIFs, collectibles, video highlights of different sports, video game skins, virtual avatars, music, and even tweets. Twitter co-founder Jack Dorsey sold his first ever tweet as an NFT for more than $2.9 million. If you are buying an NFT of an oil painting, instead of getting the actual painting, you get a digital file encoded with a unique signature. The ownership rights are exclusive. Popular NFT projects. Here are a few noteworthy NFT projects. CryptoPunks. These are created by a development studio named Larva Labs. CryptoPunks consist of a series of 10,000 images that have been tokenized as NFTs on the Ethereum blockchain. The images are of randomly generated pixel-based avatars that are selected from dozens of attributes, including aliens, zombies, and apes. Rapper Jay-Z, YouTube personality Logan Paul, and tennis champion Serena Williams are some of the celebrities who own CryptoPunks. Bored Ape Yacht Club. It was created by a startup called Yuga Labs in 2021. Each NFT is represented by a cartoon ape that has unique color schemes, facial expressions, and outfits. Celebrity owners of these NFTs include Gwyneth Paltrow, Eminem, Shaquille O'Neal, Post Malone, Snoop Dogg, Mark Cuban, and Steph Curry. Uses of NFTs. Famous digital artist Mike Winkelmann, also known as Beeple, created a collage of 5,000 of his daily drawings and developed a composite artwork known as Everydays, the first 5,000 days. This is the most famous NFT at the moment and sold at Christie's for $69.3 million. NFTs give a platform to artists and content creators to showcase and monetize their talents. The artist can sell their NFT directly to the customer or choose to program in royalties so that they get a percentage of profits every time the NFT is resold. Big chains like Taco Bell and Charmin have used NFTs to auction their themed art and raise money for charity. The NFT space is filled with real connoisseurs who would pay a lot of money for a good piece of art. This keeps the artists encouraged. How can you buy NFTs? The primary requirement for trading NFTs is a cryptocurrency wallet. You would also need to buy some crypto, like Ether, because NFT trades happen only in crypto. Some of the most popular NFT marketplaces are OpenSea.io, This platform hosts a large collection of digital items and collectibles. Rarible. Here, artists and sellers issue and sell their NFTs in a democratic environment. Foundation. This is an exclusive community where people must receive an invitation from fellow creators to post their NFT. Web 3.0. Web 3.0 is rapidly growing in popularity. Web 3.0 is the third version of the Internet, which is also called the decentralized web. Web 1.0 was the first generation of the World Wide Web, with a few content creators and mostly static personal web pages. Currently, we are at Web 2.0, where data ownership is concentrated among giants like Google, Meta, Microsoft, Apple, and Amazon. There is no data privacy as these companies have access to all our personal information. With more strict guidelines issued by social media platforms over the content that can be published, there has been a debate over how free speech is being targeted. Web 3.0 uses blockchain technology to create a decentralized version of the Internet, providing more transparency. It is supposed to be user-specific, which would ensure privacy and a hack-proof environment. Gaming. Cryptocurrencies have disrupted the gaming sector tremendously and will continue to do so. In this context, it is important to know about Axie Infinity. Axie Infinity is built on a blockchain and is an NFT-based video game that was developed by the Vietnamese studio Sky Mavis. It is a trading and battling game where you can trade, raise, breed, and cattle creatures called Axies. The trading within the game takes place with the help of Ethereum-based cryptocurrencies. The native currency of the game is called Axie Infinity Shards. The players can earn Axie Infinity Shards by playing the game. In developing countries like the Philippines, many people made a living playing Axie Infinity during the COVID-19 pandemic. The play-to-earn economy of this game has provided livelihood to thousands of people across the globe in developing countries. Cryptocurrency investing strategies. Despite the risks and volatility, cryptocurrencies were one of the best-performing asset classes in 2021. However, exercising caution is important. Here are a few strategies that can be adopted while investing in crypto. Prioritizing liquidity. The cryptocurrency market changes rapidly, which is why investors need to keep changing their positions promptly to earn maximum gains. A crypto with a high transaction or trading volume is likely to have more demand than another that has not been traded often. The trading volume indicates the interest in that asset and provides insight into the general interest in that crypto. Cash out frequently. The risk involved with cryptocurrency trading is significantly smoothened when the gains are taken often. Altcoin prices are often a piece of news or a meme away from changing drastically. So, holding on to these altcoins for an indefinite period might expose a portfolio to unnecessary risks. Diversification. Only buying Bitcoin is not the smartest choice, as we have already discussed at the beginning of this chapter. Investing in a variety of cryptocurrencies and even other digital assets like NFTs can provide diversification to an investment portfolio. Dollar cost average. Dollar cost average, or DCA, is a process of systematically investing a certain amount instead of piling up a lot of money at once. Just like regularly cashing out gains smoothens the risks, regular investing at consistent intervals helps the investor get accustomed to the market fluctuations. The investment remains constant, both in bull and bear markets, and the cost of assets gets averaged over time. This strategy is especially helpful for investors who are in it for the long haul. For example, if you wish to invest $6,000 in crypto, you can do so by splitting the amount up into 6 monthly installments of $1,000 each. In this process, the price you are paying gets averaged out. The most important thing to remember while investing in cryptocurrency is that you should not let FOMO, an acronym for fear of missing out, drive your decisions. Just because someone else is putting their entire life savings in crypto after reading an article doesn't mean you have to do it too. Do your research and make sure you fully understand the products you are investing in. We are not financial advisors, and the above strategies mentioned are highly generic. Conclusion. If you are still having anxious feelings about crypto, you should try to put them aside. By now, you know a lot about cryptocurrencies and the technology behind them. You are in a good position to make logical, informed decisions, considering all the relevant facts and figures. You can choose to not get involved in this market, but you cannot deny the immense potential that blockchain and cryptocurrencies are showing. Crypto may become a bigger part of your life in the future, whether you like it or not. The economy is changing, and digitalization is the way of the future. Blockchain and crypto fit right into this scenario because they pave the way for a more efficient economic environment that is completely digital. Banking, finance, healthcare, real estate, and many other sectors may soon use blockchain. Smart contracts show enormous promise in revolutionizing the legal aspect of business and automating many transactions. The elimination of human intervention or any third-party intermediary will reduce costs and improve accuracy. Crypto transactions will increase as more people start acknowledging it as a legitimate means of exchange. This book is meant to act as a guide to prep you for a deeper dive into the crypto sector of your choice. Crypto will not drastically change your world by making you a billionaire overnight. However, it can rob you of your fortune if you do not exercise caution and be meticulous about your investing strategy. Hold on for dear life, and you might just find yourself mooning. Good luck!